Hey everyone, it's Mike Bond with Hard Money Mike. Today we're going to go over what is a good deal, what makes a good deal, what makes a lender want to do a deal just for you. Now in the last video we went over what you should be looking for, what's the minimum, and why that 70 to 75% ARV lending is what lenders are looking for. In each deal you're looking for that 15% profit margin, because we want to make sure you're making money, because if you're not making money, you're not going to be engaged in everything. And also we're looking to make sure you understand that there's realtor fees, there's lender fees, and that's where that, that 25% that the lenders are not going to fund comes into. So if you missed it, just check out the video. It just goes through quickly where that 25% to 30% comes from, just depending on each deal. Today I want to go through what a good deal looks like from a lender's perspective when someone comes into us. What are we looking for? What makes a lender like us at Hard Money Mike want to do a loan for you? So first of all, just like I said before, we're looking to fund somewhere between 70 and 75% of the ARV. The other 20 to 25% represents everything that comes out at closing or some of your money for the cost of interest as you go through, but 15% again for your profits and 5 to 6% for closing, which includes real estate fees, title fees, and any monies you have to maybe contribute to the borrower to make it close. And we'll probably see more and more of that where there's seller concessions, where you give monies to help buy down rates and stuff, just to make sure loans are more affordable for buyers to help properties move quickly. So let's put together a deal where a lender is going to look at it and go like, that makes sense. We would love to do a deal for you based on these numbers. So we're going to start with the three things we always look for, or look at, which is, what is your purchase price? What do you think you're going to sell it for, your ARV? And also, what are you going to put into it? So the three fundamentals we're going to go over: the purchase price, the ARV, and rehab. Rehab counts, scope of work. Are you moving walls? Are you adding egress windows? What are you doing to the property that will make it more sellable, will reach the ARV that you're looking at? So we're going to look and make sure that you understand these numbers from the purchase price and the rehab, which gets you to what the maximum loan will do, and then what you can sell it for. Remember, our goal here is to make sure that you are profitable, that you make money, because we just want to lend money. We want to make sure you are completing the projects, making money so you can get on to the next deal. That's where you make money, create the wealth, create the income in real estate, is if we all win. We get a loan that is good, and you get a project that makes you money, and then you repeat this 2, 3, 4 times a year. So let's just look at some numbers here to put this in perspective on where we want to be. Let's start with an ARV. When we're looking at a property, let's just say someone comes to us with a property that has an after repair value, what they could sell it for, of $200,000. So that's what they can list it for. That's what they can get in this current market, depending on their rehab. So we're going to look at this and say, okay, the comps that they're using to value this property, does this scope of work equal what the market is showing? Are they putting in granite? Is that required? Are they finishing out bathrooms? Is that required in this market? A $200,000 market may be a lot different than a $1 million market. So we're just going to make sure that whatever is moving, whatever's selling in the market, represents what they're doing to the property too, to make sure it is like other properties that are selling for that price. So we're going to then look at the rehab. So let's just say they give us a scope of work, rehab, and it's going to be $30,000. So they're going to put $30,000 into this property. And we're checking all this. We're making sure that you as a borrower, as a flipper, understand the nuances between what you put into it, the scope of work, and what it's going to sell for. So once again, as a lender, we're looking at Do you, as a business owner, as a flipper, understand all the relationships between how much we're going to lend, how much you're going to need, and what it's going to sell for? So in this case, let's just say that we're going to lend 75% of the $200,000, because remember, we're lending off of the ARV, the after repair value. So in this case, 75% of this is $150,000. That's the max loan that we as a lender would look at. If we know it's $200,000 and the rehab's $30,000, we're looking for you to be at a purchase price of $120K or less. Now you can say, well, maybe you're going to lend $150,000 and we're going to put $20,000 or $30,000 into it, or $10,000 or $15,000 into ourselves. As a lender, we don't want to really see you getting above the 75%. This goes back, like I said, to the other video where if you're above 75%, what that is going to do is cut into your profits. If you're not in real estate to make money, to create profits, it's probably not what lenders are looking for. We want a relationship where you're making money and we're making money on interest. So even though you may have some extra money to put in this, we're looking for the numbers to make sense. That the maximum all in, maybe a loan or maybe from you, but is the 150, the 75% of the 200,000. We know to get to this particular property, when someone's walked through it, a contractor said it's going to cost $30,000 to bring it up to market condition. This lets us know that 120,000, because 120 plus 30 equals 150, is the maximum you could give for that property. If you give more, what it does is it cuts out of your profits. You cut too many things out of your profits and things go wrong. It takes longer. A contractor walks with some of your money. We know you're probably going to more than likely not make money, and that's not what we want to see. As a lender, a good deal is a deal that we see that you construct, that you put all of these numbers together and show that you're going to make a profit. You understand what it takes to bring this property up to the market conditions that'll sell for your ARV. Now we understand that numbers sometimes get confusing. That's why we're here. If you have a question, reach out to us. Just email me at mike@hardmoneymike.com. We'd be glad to go through these numbers, but we want to make sure you have these numbers and are at least putting in the effort and doing the work, finding the comps, making sure they are in the same area, they're like properties, and in like condition. You're getting the quotes, and you know that you could get the property for this amount or less. It's always better to skip and not get a property, maybe do just 2 or 3 your first year or your second year, just to make sure you hit your profit margins. Don't do deals just to do deals to keep busy and keep your contractors employed too. That's a quick way to work too hard for little money. Now we've gone over the 25%. We've done that in the last video of why you need it, because it's profit, it's selling cost, it's interest. We've also gone through it just like how do you construct, how do you quickly look at a property and say, does it make sense and is it a good deal for not only you, but the lender? Next video, we're going to go through what does a bad deal look like. When we talk to people, what does a bad deal look like? Also check out hardmoneymike.com where we have a lot of great tools. Loan cost optimizer, DSCR calculators. You could calculate quickly exactly where your ARV is. We have tools for that. Once again, check out the free tools, hardmoneymike.com. If you have a transaction you want us to run through it, just email me, mike@hardmoneymike.com, and we'd be glad to help you out, to run through the numbers and make sure you're on target to make that kind of profit. Hope this helps, and we'll see you on the next video.